Hello, guys. Good evening, everybody. Welcome to this new webinar. Today, that's the second part about the chapter, about the third module of this series of webinar about order flow. And we will be talking specifically about liquidity. Last week, we have been getting started talking about the heat map. We have introduced heat map as a tool, so we basically have started going through all of the main tools and the main features provided by the heat map as the most advanced tool in terms of order flow analysis. More specifically, we have introduced what liquidity is, what kind of principle, what kind of technical principles we can use reading at it, and also the interaction with aggressive orders. So basically, the bubbles, these red and green bubbles provided here by the tool itself. That was just a basic introduction. Tonight, we will go more deeper into the interaction between aggressive orders and passive order. That means the way actually sellers and buyers would interact each other, with the only difference that if we analyze how strong a buyer is, if it's aggressive buyer, we always have to compare it with the passive counterpart. That means the seller, the passive seller. Today, apparently, we have a perfect conditions to go through that, because since the morning, S&P 500, which is the instrument I always take as an example, uh, since it's the most traded by me, at least in my personal trading, we can see that today there were, if we go back in time, starting from the early afternoon, we can see there were many shifts actually in liquidity provision. We can see here, right after the opening, there were a lot of liquidity being at the upper side of the chart. That means that basically price was below the most relevant portion of liquidity being provided. What does this mean? Basically, that means that there is more, as we said last time, there is a major interest to go to the upside. At the same time, that doesn't mean necessarily market has to go up, because in order for market to go up and reach those levels of liquidity, of course, we need necessarily to have aggressive traders trading in that direction. And first of all, we need uh, those aggressive buyers, in this case buyers, they need to be basically dominant compared to also aggressive sellers. But this gives us a first indication of where there is more interest to go. Okay, liquidity as a first indication, it will provide us, it will just say we are interested to go to the upside or to the downside. Okay, this is what we said last time. Now, how can we use this information in our trading? Well, first of all, we need to distinguish between attractional liquidity and rejectional liquidity. We shortly introduced this topic last time, and we need to talk about that tonight. Well, in a little while, because how can we actually distinguish when a liquidity pool would act as an attractor for price or as a rejector for price at first place? First of all, we need to look at what time that liquid, for how long that liquidity is actually being as a resting order over there. Because normally, as first, there are just three things we need to look at. Three things basically in terms of time. Normally we tend to have liquidity pools attracting price when we have liquidity which has been resting here in the order DOM for a long time. So normally liquidity being here for a long time, they would tend to attract price more easily compared to that liquidity, those liquidity pools, which have come to market and have been sitting in the order book for a shorter time span. Okay, this is the first indication, the first aspect we need to consider when we look at a specific liquidity pool. In why? Basically, because first of all, a liquidity which is in the order book for a long time is already accepted by the market. That means that whoever needs to exchange a relevant amount of contract needs to go there if those trades needs to be facilitated. So all market participants would know that acceptance will be where more liquidity is provided, because if we look at this very straightforward level of liquidity, we can see here 730 lots here on this area. That means that there are at least 730 contracts which is possible to buy. Those are selling orders, those are sell limit orders. That means that 731 actually are available to be bought, because there are 731 sellers which are waiting to sell. So that would give us a first indication that over those prices, trades will be facilitated. And for this reason, market will tend slowly to get there. Okay. On the other side, what happens where we have still liquidity, like this one, also this one, which appears here in the order DOM, but it hasn't been resting in the order DOM for so long. Yeah, trades are still facilitated, but that's a kind of acceptance which market and market intended as more widely as market participants, they don't expect so many sellers to be there. They just suddenly appear. That means that suddenly, if buyers want to push the market through, they will have to use way more contracts compared to what they thought. Okay, so that's a liquidity which market hasn't accepted completely yet. This works both ways actually, because when we have liquidity pools appearing here in the heat map straight in front of the price, but which is not there for that long, then this is the kind of liquidity which tend to reject price at first place. That means that price will have, like in this case here, will have a natural resistance to just go through. Then this doesn't mean, of course, market can't break through this liquidity and just go farther, but it will just tend to slow down, at least slow down a little bit. In fact, let's say that market liquidity, short-term market liquidity, which therefore tends to reject price at first place, ideally, it is very useful to identifying a possible target, especially for scalping. If I am long somewhere here, let's assume I'm long somewhere here, I know that a little bit before this liquidity, maybe a couple ticks before, that will be a nice place to at least attention my trade and eventually either exit my trade and taking profit, or otherwise just watching my trade more closely and see if actually buyers get stronger here and maybe they will have the weapons to break through this liquidity. So this is the first way we can use this principle. Another way we can use the very same principle is when short-term liquidity, which therefore still act as rejection liquidity, appears below a price move. An example can be seen here. Let's say here. Price after a small retracement breaks a new low, new high. As soon as the high gets broken through, we can see that there is new liquidity appearing right behind the price rise. Of course, this is still to be considered as rejection liquidity because it hasn't been here for that long. It is still a fresh liquidity, it's a new liquidity. And it is a short-term liquidity, which in this case, just the thing that it appears behind a price which is going in the opposite direction gives us that what's happening, what's really happening here. Well, price is rising. There are buyers willing to buy passively at always higher prices. So they are still passive buyers, but they aren't as passive as they used to be because they are chasing price. Of course, market doesn't come to them to get them filled, just takes off from here and they will just chase price with their orders. In some cases, in some other cases, which let's say most of the time it would just happen in both ways. Some buyers, passive buyers, would just change their mind and become aggressive. They would just remove their orders, their pending orders, which can be removed at any time as they are just intentions, as we said last time, and they would just decide to buy at market, not to wait anymore, tries to get back to them. In fact, this graphical pattern, it is quite a reliable confirmation of a possible reversal. Let's go back and see if we had some example of this here. Here as well. After we made this low, you can notice how slowly liquidity was moving up behind price. It's not that clear in this area, but it becomes way clearer here, where we can see price trying to retrace a little bit. Liquidity gets added up in the order book below. This is buying liquidity since it's below the current price. Something similar happened here as well. As price hit this liquidity, started to move back up, and as it was starting to move back up, this liquidity was added behind the price, like in a supporting way for price to rise. So basically, what's the difference between attraction liquidity and rejection liquidity? Normally, both liquidity can reject price because, as we said, we need lots of buyers or sellers, aggressive ones, to hit the bid or the offer and consume actually all of that liquidity. They need to eat that liquidity. But the main difference is that attraction liquidity tends to attract price first, and then possibly, according to what happens when aggressive participants would interact with it, would react to this liquidity. There will be a fight here between buyers and aggressive buyers and passive sellers. And then we need to detect who is the winner, who is stronger, and make our trading decision according to that. Rejection liquidity tends to reject price at first place, even if it wasn't traded by the tick. It just tends to add some pressure in the order book made by passive orders. Is not a proper pressure, as we said, the same kind of pressure we have talked about when we said about imbalances in footprint. That's made by aggressive buyers or sellers. This is a pressure in the book, in the order book. If I have so many contracts here, and then as price rises, I have more here, and then again here, it will be always more difficult to either sellers break that wall, which is slowly building up below the price, But also it is way more unlikely that sellers would initiate to the downside because they know, they are aware that there are an harder wall to break through. So that's the main difference between rejection and attraction liquidity. In fact, in terms of trading, operational trading, there are so many ways to trade this kind of principles, but as a rule of thumb, I would say we should never, if price gets close to this liquidity here, which has all of the characteristics of attraction liquidity, long-term liquidity, normally high sizes, relevant size compared to the average of the order book. We can see here level by level we have an average of 100 and something. This is 721. That's a lot. That's outstanding. We don't need, of course, to have that's an extreme example, but of course we don't need to have all of these contracts being there, being so different by the average. But let's say for an S&P 500, normally, whenever we have a liquidity pool made by more than 300, 400 lots, then it is relevant. It can be started to be considered as relevant. So when price, and normally third condition for a liquidity to be considered as a attraction liquidity, normally we can see that this line, this band representing liquidity is steady over time. So we don't see those kind of shading continuously changing. Either the shading of the book of the heat map, as well as the level where the liquidity is placed. Normally it is very neat, as you can see, as opposed to protection liquidity, which tends to be kind of dirty in terms of levels where it is placed. So, said that, liquidity pools acting as attraction liquidity should never be traded looking for a bounce if they haven't been traded before. That doesn't count, of course, for the entire day, because in this sense, according to this statement, today we shouldn't have been looking for a short at all, even though there were some nice short moves, right? Right. This is way more important when we are very close to the level, a few points, let's say, and also if we don't have any other liquidity, maybe acting as rejection between the price and the attraction liquidity. in a nutshell, here, could we have seeked for a short trade? Yeah. Why? Because we are not that close yet to this liquidity. We have another liquidity in between, and this one comes with the features of a protection liquidity, so it doesn't necessarily need to be traded. And also, there was another liquidity here, which apparently was traded, and buyers have failed to go through. In this case, even if we have this liquidity right here, we don't need to wait for it to be traded. But let's make another example, which I need to use a screenshot I've made this morning. That's still the ES. There was this liquidity right here that in that moment acted as an attraction liquidity. Could that have been traded to the downside right here? No. Or at least it was quite dangerous, even if after we had the down move. It was quite dangerous right here because we were very close to it. We didn't have any relevant liquidity in between the price and the liquidity pool. And on top of that, we could also see that as price went up, slowly reaching that liquidity pool, there was some more liquidity stepping up from below. This is rejection liquidity, almost creating like a stair for price to slowly reach that liquidity. That's a perfect example, I would say. For a proper short, it was definitely safer to just wait for price to reach this liquidity, look the way bubbles would have would have given us some information in terms of who is stronger, aggressive traders or passive traders, and then eventually, if aggressive were weaker than passive traders, then we could have go for a short trade. Only in that case. Could have we gone for a long trade? Definitely yes. That's what I did personally right here, because this liquidity is likely to make price bounce. It's likely, it's not sure, of course, it's not 100% sure, but it's likely to let price bounce on it. I have this one acting as a magnet for price. On top of that, I also had what here, of course, that has to be also put in conjunction with some other confluences. What was happening here? price was rejecting, was already trading above, outside the value area of the daily profile at that moment. What at that moment was the daily profile. And actually was not accepting back into the value area. And this liquidity, rejection liquidity, came exactly on the low volume area of this profile, which, as we said in one of our first webinars, it can easily act as a rejection zone for price. So there is already, by just those two confluences, two clues which go exactly in the same direction. Then, exactly in the moment where I have taken the screenshot, you can see that price is going up very well with nice green bubble. That means that buyers started to get aggressive. They're not just waiting price to come to them, they're just lifting the offer. Volume and delta is confirming that. And as price goes up, look what's happening here. I have this tiny liquidity pool showing up exactly a couple ticks below the price as is pushing aggressively to the upside. In the very same meanwhile, this liquidity is weakening. It's still there, but it shows like it's slowly weakening a little bit. That means that, yeah, I have many reasons to think that price would reach the liquidity pool, but also at first place, and then also that if buyers continue pushing to the upside with such strength and sellers keep on defending the level with this strength, which is weakening compared to a few minutes ago, it is also more likely to break the level, because it's like a wall with a door which is slowly opening. So we can consider liquidity this way. Let's say normally price always tends to go from liquidity to liquidity. So it is reasonable enough to think that if price bounces around the area, they always have to be considered as areas, of course. If price reacts from here, where is it likely to get? To the next liquidity pool, especially if that liquidity pool comes with all of the attraction characteristics. In fact, let's go back to the real-time market. We had a nice price bounce from here. We don't have basically anything until we get here to 4,530. This level comes with 220 something contracts being there, is not that relevant, as I said earlier, considering a general threshold of 300, but we can see that the color of the band is yellow, so it is the tool is starting to indicate this liquidity as already relevant, meaningful. So that means that this up move is likely to get at least somewhere here. I say somewhere because sometimes a liquidity pool can just miss by a couple ticks, but those liquidity pools have to be considered as areas, of course. That's sure if for some reason, let's assume I've decided to enter long somewhere here, maybe here liquidity, this liquidity mean here tells me that probably that's my first best level of target, either final target or partial target. And this is also confirmed that here we have exactly at the very same level also an high volume node, which are particularly useful as target prices where market is likely to lead up to. There is a question about the name of this software. The software is called Volbook, and it is basically an heat map. It's provided by Volumetrica Trading. If you want, I can show you the website. Here it is. Basically, Volbook is the second software for the entire suite that we have been talking about for all of these webinars. The only difference is that in the first 2 months of this series of webinars, we have been talking about volume profile, footprint, charts, as said in general, charts, and that software is Volsys. We have been using Volsys. Okay, so you might recognize my screen from the screenshots you can see here. So Volsys will provide you all of the volume tools included in the charts and profiles and order flow tools such as footprint chart and cells as well. This is Volsys. Volbook is the software we are talking about tonight, which is basically a heat map. It will show you the visual order book, so basically the DOM, the depth of market, represented by visual level. Okay, I have just set it up in a different way, so that's the reason why you might see my colors being a little bit different by the ones showed up here, but that's exactly the very same software with the very same features. So this software is the most advanced tool for order flow analysis, and it is specifically designed to only show either the order book in a visual representation and also the volume bubbles representing the aggressive orders. So ideally, if you want to trade on charts, but you also want to include in your analysis where we have liquidity, the way volume bubbles are showing aggressive orders and everything, ideally you need both softwares. Then, of course, in this heat map, there are also additional tools like daily volume profile here, delta profile still for the day, a resetable delta profile, which I can just reset by clicking at here. So it would just create a new profile based on delta from every time I would erase it from now on, basically. And also many interesting functions which aren't strictly related to the heatmap concept, but they are useful anyway. In fact, we will be talking like the indicator for stop orders and iceberg orders. We will talk about that in our, if I remember that right, in 2 weeks. So in our last webinar, we will talk specifically about the stop and iceberg indicator. This one is very useful because it tells you for native iceberg orders, it detects native icebergs with 100% accuracy. It tells you this one, here there is an iceberg order made by 300, 500, whatever it is, contracts. So you know for sure there is an iceberg, and how many contracts are involved in that iceberg. So definitely useful. So back to our topics. What's the most important thing I want to look at when I reach liquidity, when price reaches liquidity? Well, first of all, as you can see here, price went exactly, well, two ticks far away from liquidity and then rejected. Well, it's not that much of a rejection yet, but ideally that could have been a nice 4-point scalp. I'm not saying this is a scalping setup, but if you have other reason to take a scalping setup, that's definitely the final confirmation. So maybe, just to recap a little bit, let's assume we have an absorption of buyers spotted in the footprint somewhere here, and we also have some liquidity being above price, acting as rejection, as possible rejection. Of course, we have a confluence generated directly by the order flow. So we are not using technical levels or specific indicators, or those are information which are generated by the market, by the orders. So we are analyzing what market really tells us with passive and aggressive orders. Price now is continuing to confirm this bounce, actually. So the most important thing is that when we see liquidity, of course, it wouldn't reject and price wouldn't bounce all the time on it. Otherwise, we will have market which are constantly ranging, and of course is not. Well, market tends to range about 70% of time, but what about the other 30% of time? Liquidity pools can also be broken. Like it has happened here. That was a liquidity rejecting as it showed up. It was quite recent. Here it showed up immediately to protect price. And then after, we were like 20, 30 minutes away from that event. Let's say, how long? That could be a possible question you might have. How long does a liquidity needs to be in the order book before I can really consider it as a proper attraction liquidity? Well, I would say as a rule of thumb, 1 hour or more. But it's not only a matter of time. It is also a matter of times that price comes back and retests the level. Pullbacks are always a nice chance to catch a nice possible move that sometimes we might miss out, right? The thing is that if too many pullbacks occur on a level, and that counts also for liquidity pools, first pullback, second pullback, third pullback, and here it breaks. The thing itself, that price came back and made 3 pullbacks on the area, that means acceptance. That shows acceptance. That's an evidence of acceptance. Otherwise, price would have just made 1 pullback and then get away from the area. So this liquidity hasn't been here for that long, less than an hour, way less than 1 hour. First rejection, and of course here, if you wanted to trade that, you would have to be aggressive, as you could see the liquidity showing here, long right away, in an hypothetical way. Second and third pullback, price is still here, but it had 2 chances to get away from the area, and in both cases failed. How did price fail? In the first time, buyers, after pulling back here, got exhausted. Why? Because we just can't see green bubbles at the top of the swing at all. We see dark green bubbles, but tiny ones. At the top of the screen, there aren't buyers at all. During the second attempt, we have some more buyers, and also the delta and volume indicator below shows that actually there is a delta strength to the upside. But apparently it failed. It failed completely. As price goes down, red bubbles get always bigger, and there are no green bubbles at all. An attempt supported by delta, supported by, well, not that much, but I would say on average, anyway, volume. The second attempt was absorbed. Big bubbles failing the move, absorption. Small bubbles or no bubbles in that sense of the move, exhaustion. This is the way we can read bubbles on every single swing to just determine how strong buyers and sellers are. In this case, we are looking at aggressive actions. What aggressive buyers, either sellers or buyers, do. This is quite important because this gives us what? That helps us identifying the controlling swings. According to this information, so either where buyers or sellers have failed, and then where other, in the other side, aggressive traders took control, that's where we have the most important area of basically supply or demand. Information taken by the order flow. This is important anyway, but this becomes even more important when those kind of event would happen close to the liquidity, close to liquidity pools, and also when liquidity pools would then defend, like in this case, something which has already happened by the market orders. So there is still a relation between aggressive and passive traders. There has to be. This is an introduction of, a quick introduction of what we will be talking about in the next webinar next week, because we are gonna see together what happens where market hits liquidity, or more specifically, when market orders hit liquidity levels, liquidity pools, what does normally happen? How can I determine who is stronger? we need to look at the order flow events, which is exactly the interaction between passive and aggressive ones. We need to see, like in this case, that's very clear. We have lots of red bubbles hitting and eating this liquidity. It's not that much of liquidity, but according to the area, it is important. That's a relevant one. How would you say strong sellers are stronger than those buyers? Well, first of all, I can already tell by the size of the bubble that, yeah, they have put lots of effort in hitting that liquidity and breaking through it. The thing is, though, and in fact, after a quick retracement, then price breaks through. With a nice acceleration. In this case, is market breaking genuinely here or not? Well, compared to here, I would, if I was short here on this trade, I would be way more confident looking at this swing to the downside here as opposed to this one, because here I see lots of strength. Look at volume and delta as well. Creating a retracement. Then no buyers came in. So price is still kind of weak. But at first place, sellers were unable to break through instantly the level. At the second attempt, bubbles are tinier than they used to be in the first attempt. But, and we can also see some green bubbles in between. The key difference is that here, after every attempt of buyers to go back, there is a stronger response by sellers, which actually are able to move price down with less volume than they used to do here. So this is what happens normally during initiative moves. We don't have huge bubbles, but we have, like here, steady, medium, average sized bubbles. We can still tell a dominant color. So during initiative to the downside, it is normal to have some green bubbles, but majority of those bubbles will be red and on average bigger than green ones, and vice versa on initiative moves to the upside. next time we're going to talk about absorption and exhaustion when we get close to liquidity levels, because in this case we can combine those way of reading price bubbles, volume bubbles, and putting that in conjunction with liquidity levels, so we can determine whether liquidity, once it gets traded, if it can really bounce price, or it is likely that will be broken through. Okay, I think that's all for tonight, guys. Thanks for attending once again. Hope you like the topic and the new principles we are talking about. As usual, see you next week with the topic I've quickly introduced right now. I wish you a fantastic evening and good trading.
Thank you very much, Edoardo. Have a good evening, everyone.
Thank you, Alex. You too. Bye-bye.
Bye, bye, bye.